The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to the property edition of Your Money, Your Call. I'm Brad Beer, filling in this week for Margaret Lomas and looking forward to a great night with my expert guests. But first to the news. Strong Sydney property market means it's taking 10 months more saving to get into the market than it did in 2013. A Bankwest first-time buyer deposit report says it will take 6.7 years for first-time buyers to save the 20% deposit of $165,000 required to purchase a medium-priced Sydney property. This is an increase of 10 months on the same point in 2013, and it's $40,000 more than the next most expensive capital city, Melbourne, at $126,200. With 5.5 years of saving, and it's considerably more than the average capital city deposit of $104,813, according to the report. In the comparison, the New South Wales average is 4.8 years, Victoria 4.4 years, the ACT 4 years, Northern Territory 4.1 years, Queensland 3.8 years, WA 3.7 years, South Australia at 3.3 years, and little old Tasmania at 2.7 years. And also, there's 3 of Australia's capital cities are expected to experience higher capital growth in 2015 than they have this year. CoreLogic RP Data Head of Research Tim Lawless forecast that only Brisbane, Adelaide and Hobart would improve, with Brisbane the standout. We're expecting the annual rate of capital gain to finish the year at around 7%, compared with 5.1% over the 2013 calendar year, Mr Lawless said. With the rate of capital gain holding relatively firm over the second half of 2014, fewer affordability pressures and better rental yields than Sydney or Melbourne, we're expecting the growth in Brisbane dwelling values to outperform the capital city average. Mr Lawless said Adelaide would also move forward next year after posting higher capital gains in 2014 than 2013. Not a surge, but a modest rise is likely. We also expect a similar story in Hobart, with some extra demand from lifestyle buyers. Hobart's been the weakest of any capital city since the GFC. It's going to be a great night. With me tonight on the panel to discuss these stories and, of course, answer all of your questions I've asked and other matters. I've got the real estate author Peter O'Malley and property expert Robert Klaric. Welcome to the show, gentlemen.
Great, fantastic.
So the average time it takes to save and buy a property obviously has increased. We've had some increases in pricing, which will impact on that. 6.7 years is a long time saving. Your thoughts, guys?
I would say that first home buyers don't need to buy in Sydney as a first property. There is tremendous value outside of Sydney around the national property market at the moment, and I'd encourage first home buyers to look outside Sydney if they're feeling it's beyond reach.
Yeah, and Peter, look, outside of Sydney or even maybe a different suburb. Sometimes Sydney's, we're looking at the median price, it says 6.7 years. So outside of those main areas, maybe it's not quite so many years to actually save up for that deposit.
Well, once upon a time, you'd say that Western Sydney would offer value for first home buyers or opportunity, but that's not the case at the moment. Western Sydney has had astronomical gains in the last 2 years, percentage-wise, probably stronger than in the inner city. Central Coast may be showing a bit of value. That certainly hasn't gone to the same degree that Western Sydney has. But as you've seen there in your intro, Brad, at places like Hobart, whilst they may be unfashionable, they may be very good buying.
Yeah, I think that's correct, Brad. I mean, well, I agree with Pete. I think for the Generation Y and even in our own home, we've got a 21-year-old and a 22-year-old, and we're on the north side, and they're looking at scratching themselves at the moment. And how do we buy? Well, maybe don't buy in your own neighbourhood that you've grown up, but certainly look at the other options. And other capital cities in Australia will represent good buying, and there's a good opportunity and a great investment opportunity in other states in Australia to actually be a first home buyer or a first home investor.
Yeah, and Robert, I think maybe sometimes the expectation of what we're going to buy as our first home, median price, the first home that I bought, and also that I suppose our parents bought was cheap. it was well below the median price in the area, and I did a lot of renovations, a lot of work to that to try and make some money out of that property to help sort of leverage into the future properties, and it's definitely something to consider.
Well, exactly, and I mean, it's funny, I think the kids of today, they'll probably hate me saying it, and the kids will probably be watching it, or at least hopefully they'll watch the show at one point, and they'll say they're used to, and they're a bit spoiled living in certain affluent areas, but we didn't all start, Pete, in affluent areas. I mean, started way back in Erskineville and then moved over to the inner west of Enfield, and okay, I'm fortunate enough to live on the north side today, but that's taken a journey to get to that distance. So, and I agree with what Peter was saying before. I think potentially we've got to look outside certain areas or certain pockets that you've been used to growing up in.
And Peter, I guess also, you know, Brisbane hit by RP data as maybe the most growth for next year.
We sat here this time last year and said the same thing, and to some degree that was correct, but I think it was a surprise for most that Sydney and Melbourne continued to outperform. I'll say the same as last year. I don't expect that to be the case next year, and I think Brisbane will come through. I'm probably more confident on Brisbane this year than I was last year. And this time last year I was actually reasonably optimistic about the Gold Coast having hit a bottom, and whilst the Gold Coast didn't experience any dramatic price growth in 2014, it did consolidate, which is terrific. And if this Australian dollar continues to go lower, as every indication suggests it's going to, holiday marketplaces will be the beneficiary of that. As Australians stop jumping on Jetstar and heading to Bali, they'll start holidaying domestically. So look out for the holiday markets next year as well, is my tip.
Yeah. I think, you know, often I believe the holiday market probably is impacted on by the rest of the market, because if people make a little bit more equity out of their existing properties, we've had price growth, and especially in Sydney that's been hefty, a bit more equity there, they start thinking about the holiday property sometimes.
It's boom bust, and when you accept that it's boom bust and you ride the cycle, there's still good buying and profits to be made in holiday markets if you're buying right.
I think we'll go to our first email for the night. Our first viewer email is from Reddy in Sydney, who asks, we intend to buy acreage in New South Wales for investment purpose. Could you tell us the pitfalls of buying acreage and what other things to take care of, to take care while buying it? Now, rural and acreage, I suppose, maybe Rob, we'll start with you. Your thoughts?
Yeah. Well, like everything, if you're looking at an investment, and I'd love to know the reasoning that Reddy wants acreage, because it seems like it could be two parts to this question, that they might be looking at as an investment, an acreage, for long term, so that they could eventually one day go there, or alternatively, if it's just as an investment, it always boils back down to the return on the investment and where it is and where the property is located. So firstly, my advice, Reddy, would be to do your homework and research the area that you wish to buy the acreage, and look at the return on investment, because it's so important if you're going to buy it as an investment. Well, that's got to be the first criteria. That's my thoughts.
Yeah. Look, purpose is the big one here, of course. Is it a development play? Is it farming? Is it just a buy and hold? The yield on acreage properties doesn't tend to be as good as a normal house. I find acreage is either rocks or diamonds. You can own an acreage property for 10, 15 years and it's worth the same after 10, 15 years as what you purchased on the way in, or the urban sprawl can overtake your property and suddenly you're sitting on a multi-million-dollar asset. So I think we need to look at the purpose behind the buying there.
Yeah, thanks, Peter. And I think to add to that, often land banking is something that looking at some sort of future change in planning that you may be able to develop that property, and sometimes trying to wait for that as your first property is probably not good. We need to know a bit more about the circumstances, but something like that only if you think it's going to happen and you've got other property that can handle that cash flow on the way through. Yeah. We've got Amy on the line from Melbourne. Amy, you have a question?
Hi there, thanks for taking my call. My question relates to the Campbelltown local government area below Sydney there. I'm trying to find a neutrally to positively geared property in sort of more regional New South Wales or outside of Sydney. I just wanted to know what the panel thought about that Campbelltown LGA, particularly Ingleburn and Minto.
Okay, so Peter, I suppose first, Campbelltown, Ingleburn.
It's really benefited from the motorway extension of the last 5-10 years. It's a lot closer to Sydney, so Campbelltown is on the edges of Sydney. I wouldn't call Campbelltown rural, would you, Rob?
No.
No,
Not these days.
Yeah, once upon a time, exactly right. Going past Campbelltown, you might call it rural Ingleburn, but not now. So I think you've got to look at the fundamentals there in Campbelltown, and the things that I would zero in on in Campbelltown would be vacancy and employment.
And Rob?
Well, my thoughts, Amy, is that you look at that area and the growth that we've seen in the last 3 to 5 years, and it continues to, and the growth in Sydney has been going west. You know, I think there's growth in that suburb. Infrastructure is the big key. You know, the motorways, as Peter said, so important. It's connecting the rest of Sydney up. Look at the rental return again on the investment. I think that plays a critical part. You mentioned that you want to positively gear, and I think parts of that area allows you to still do so, as opposed to being closer in to the Sydney market, where you're having to borrow more. You're not necessarily going to get a positively geared investment. But I think in that area, from you've mentioned Campbelltown as well as Minto, do your research, go online, see what's available, and work out your rental returns on your investment. I think you'll be pleasantly surprised that you might be able to get something that's positively geared.
Great.
Yep.
Great thoughts from the panel there. I think in those areas, looking for some positively geared properties is probably still potentially available. It's sort of mortgage-built area it's a bit of a distance out of Sydney. The roads are a lot better. It still does take a bit of time if you want to do that commute, but often the commute's not as necessary as it used to be, so maybe not so bad, that Amy, in that respect. I think I'd have to say, sorry, thanks for tuning in. Even though Margaret isn't here, we're still giving away one of her books to the question of the week. So every Monday night, the panel chooses one of the questions from either emails or the calls this week. The best email will receive how to achieve property success. All you have to do is call us on 1300 30 34 35 or email property@skynews.com.au with a question. Then make sure that you watch at the end of the show to see if you're the lucky person. We'll take a short break now, and when we come back, we'll take some more of your calls and emails. Welcome back. I'm Brad Beer, and joining me tonight are real estate author Peter O'Malley and property expert Peter Klaric. We've been chatting about different aspects of property investment, and if you have a question on these topics or my field depreciation, grab the phone, call us on 1300 30 34 35, or you can email us on property@skynews.com.au. We have a caller, Kate, on the line from Sydney.
Taking my call. I'm curious on a property on the water up in Beachmere. It's been very flat for a few years, and I'm wondering if you class that as part of Brisbane.
So Beachmere, you own the property, Kate?
I do.
Yes, and you've had it for some time?
Yes, a few years.
And is it sort of well above the median price or around that?
Well, it's around that, but it's on the water, yep. And it's just been very flat, I guess, for the last 3 years. Nothing seems to be moving in that area.
Yeah. Your thoughts, Robert?
Yeah, look, Kate, I've had clients of mine that have actually retired up that way, and it's a real mix, the area, because a lot of it's quite pretty, and a lot of people like to actually, as I've said, sold up from Sydney, have gone up to that neck of the woods, and love the lifestyle. But it has been slow in terms of its growth through there, and it's a real mix match of developments that have gone on through there. So it's very much a specialist buyer when you go to sell through there. And also I think it's an area that's not just reliant on Brisbane coming into your area to buy it. A lot of the buyers that have bought along that coastline and in that location have been from areas like in Victoria and Melbourne, moving up to the north, or in Sydney, moving up. So they're sort of the downsizes. You'd agree, wouldn't you, Pete?
Yeah, very much so. It's a baby boomers market. Yeah. That's what I'm seeing Beachmere as, not a holiday destination that we discussed before the break that'll be benefited by the lower Australian dollar. This is the story here is really about baby boomers from Sydney, Melbourne and Brisbane heading north, and let's face it, that is only going to increase in the next year and decade ahead, but when you will see real price growth in Beachmere is kind of anyone's guess.
Yeah, and Kate, you know, great information from the panel there. I suppose my thoughts to add is property really often is always should be a bit of a long-term play. It's been flat for some time. We're having growth in Brisbane, or had some growth, and RP data tells us we might have some more next year, but no one has a crystal ball, unfortunately. And being still in proximity, I suppose, there's always a chance that you may have some ripple effect of that growth, but if it's stopping you from investing out of the property, then maybe you've got to consider the concept of moving it and getting into something that's a little bit better. We have Judy from Sydney on the line. Judy?
Oh, hi, Brad. Sometimes properties are advertised with the suburb name only, with no street address. In particular, I was looking at one suburb, and there was quite a lot of properties that just had the suburb name only and no street address.
Yep.
Do you have any idea why that would be?
Well, I might throw that to one of these guys. They've probably got more of an idea on that.
Yeah, Judy, this is what I call the digital footprint, and RP Data and realestate.com have an alliance. Domain and Home Price Guide are both owned by Fairfax, and they share data. And if you're in a slow-moving marketplace where your property, where properties tend to languish on the market, that data is recorded against the property's history for all time, as is failed auction campaigns, I might add. So what you'll find in slow-moving markets is the vendors and the agents, quite rightly, will choose not to advertise the address so as not to create a digital footprint against the property, which could harm the vendor's interests in the future.
Look, and interesting, it's really, Judy, quite amazing how much information you can find online just about properties when they have been on the market. As a buyer, that's actually quite handy sometimes, but I guess that's probably why they ended up advertising as a suburb, because not giving so much information away that ends up shared with a lot of the public all the time, I suppose. So yeah. Very interesting.
And on the flip side of that, a lot of the agencies will just put a suburb to get you to call so that there's a connection. They can actually tell you a bit more about the property. So from a marketing perspective, you'll find that happens as well, Judy. So
I think best to always keep an eye on what is on the market. Ring up, ask some questions, ask address, and then you will be able to find. And if you're looking over time, you'll see what comes off the market and off the market at whatever sort of price that it does actually come up at. Might go to another email now if we could. And we have an email from Pauline about split depreciation schedule. So tonight's probably the night for this one with me on the show. I might answer this one, guys, if that's all right. And the email is, we have investments split 50-50. What is the benefit of obtaining a split depreciation report as opposed to the accounting splitting the depreciation between the two of us at the tax time? Is there any increased charge for the split report, and can this be done after depreciation has already been claimed for a few years with a standard report? If so, is there a charge for BMT to do this? A split report has some benefits whereby items are treated a little bit differently. So what happens is the value of that item is actually split before you apply some of the rules. A lot of low value items actually get claimed a little bit quicker at the start, and you only end up with your percentage ownership of that particular item. If it's 50-50 or whatever it actually is, you might get a little bit more deductions if it's actually split properly and split between the two reports. The answer is no, we don't charge any additional to split those reports. If you've had one done in the past, we'll have a look at it and see if it's worth actually splitting it. Not always does it actually make a massive difference to the numbers, and when in the past, if they haven't been split, the answer is yes, they can still be split, and we can split them up afterwards at no charge. Splitting of depreciation and depreciation schedules on properties, we're in the business of maximising those deductions, and you guys would see your clients, you know, probably a bit more informed these days about depreciation on their properties, I suppose. Very
much so, and every dollar's important these days. So in terms of the depreciation schedules, when they go to do the tax returns, I'm just pleased, Brad, we've had you here tonight to answer the depreciation schedule question.
Look, there's a couple of depreciation schedules in the questions in the email, and I guess I'm probably the best guy to answer those. I probably don't need to throw them around. I'd like to take a little bit of a step back, I suppose, to some of the original news stories, and something I've seen thinking of depreciation there is we've had a large amount of increased depreciation schedule orders in a lot of regional areas over the last year. I did some stats and pulled some data recently, and some of the regional areas that are actually a little bit wider than whether it's the Campbelltowns or even further, I think things that popped up are like Nowra, 2 hours from Sydney, places like Fremantle, an hour and a half or less than an hour out of Perth, and even Cairns regional areas. And I think that decision on whether to buy first to start with, or to actually buy something that's less expensive and to invest in to actually get into that market, is one that's we've seen an increase in those areas much over and above the state increases, probably because the entry price is actually a bit lower. You've seen your clients, I suppose, come into the regional areas a bit more?
I think so, and also the new products that have been produced there, and the new apartments that have been built in those areas. And obviously the depreciation for a new dwelling is always going to be better than an old dwelling. So, and as you said, the entry point has been a big play factor for a lot of people getting into that market. You would have seen that too, Peter?
Yeah, look, during the GFC, economists kept telling us, not just in the real estate market, but across the entire economy, that there's a lot of cash on the sidelines. And these low interest rates, there's no doubt, have brought cash off the sidelines, and you're seeing yield and the hunt for yield and a hunt for a return from investors, both in the share market and the property market. They do run on similar emotions, you could say, and I believe that's what's happening there. Is you're seeing baby boomers with all of this cash not getting a proper return in the bank, and it's the hunt for yield. And let's face it, some of that buying that you've described there is what I would call risky buying, and you do need to be careful running up housing prices in outlying markets.
Look, I guess you take at 6.7 years to save your deposit for the median property in Sydney. Yeah. If we have any growth, you can't beat that. You can't beat that by saving. It's only going to get longer as time goes on if we actually have growth in property. So actually getting into the market in some of those areas that maybe doesn't take 6.7 years to save to actually get there is probably something.
But again, I think it's the research in those markets that you want to get into, and this is something Peter and I were speaking at before we came on tonight. It's about where would you position your money and where would you invest today as the prices have all gone up, especially Sydney and Melbourne. Therefore, we've got to be looking at other markets, not necessarily that they need to be only an hour or two out of the major cities, but if you can still get the capital cities of Australia within a 10-kilometre zone, it's a great way to start with that.
It's time to take another break, but if you do have a question for us, call us and you may get a copy of Margaret's book, How to Achieve Property Success. You can call us on 1300 30 34 35 or email property@skynews.com.au with a question. Make sure you watch at the end of the show to see if you're our weekly winner. We'll be right back.
Mate.
Welcome back to Your Money, Your Call, and thanks for staying with us. Before we go to the phones again, here's some news about a fabulous event which I'm privileged to be a part of, which kicks off on 20th of February in Sydney. Margaret Lomas and a hand-picked team of top property experts in Australia will be touring the country, starting off with Sydney for a special event which we've called our one-day property intensive. 6 property investment professionals committed to transferring their wealth of property investment experience and knowledge to everyday investors. With nothing to sell except expertise, your property team has created a national property intensive, single-day seminar series designed to educate and illuminate property investors, regardless of where they are in their property investing journey. It's a great full day of property education, and with tickets at just $410, you can't afford to miss out. We'll only do this once a year, so this is your only chance to get ahead of the game and leap into your property investing nice and early in 2015. Go to www.yourpropertyteam.com.au for your instant booking confirmation. Now we'll go to the phones. We have Jane on the line from Melbourne. Hello, Jane. You have a question?
Hi, yes. Thanks for taking my call. My question is, I have a property in South Frankston and it hasn't gone up for a couple of years. What are the growth drivers in Frankston General and the indicators for growth in that particular area?
So Frankston, you know, southeast.
No, it's Frankston South, not Frankston North.
Frankston, okay, so Frankston South. So we've had, you know, the shutting down of car manufacturers and things that probably haven't helped that market. But Peter, any thoughts on Frankston South?
Well, look, on a broader spectrum, first of all, the price growth of the last 2 years has been mainly around the Sydney, Melbourne markets, not the outlying markets. And to hang on to that property in Frankston, you're relying on the ripple effect as such, is that home buyers, fatigued home buyers in the inner Melbourne ring, weather-beaten, looking for more value outside in places such as Frankston South. When you're in a market that's flat and you're continually reading in the media about other markets that are booming, there can be a real sense of frustration that you're missing out and everyone's profiting. And we've already seen that once tonight with the lady up at Beachmere who was complaining that the property market there had been flat for 3 years. Let's face facts, Sydney didn't go anywhere for 10 years. It'd have a year of growth or 18 months of growth, and then it'd lose it all in the next 12 months. It's only in the last 2 years that Sydney has actually broken out of this band that it was trading in for 10 years and actually put growth on growth. So Frankston will have its day, but if you're in real estate to try and profit every year in terms of capital growth, you're going to be really disappointed. Property doesn't go up in a straight line, it spikes. And Frankston won't go anywhere for a period of time and then suddenly you'll get a spike. Now that you're already in, what I would say is you've got to hang in.
Yeah, interesting.
Any further thoughts, Rob?
I mean, with that, and as what you said before, Brad, with it, it's so important that real estate's a long-term investment and it's not a short-term. You may not have seen the growth that the other areas like in the centre of Melbourne and centre of Sydney have, but it is a long-term. So if you're going to, again, ask yourself the question, Jane, whether you're looking at, is it an investment that you want to hang on to for quite some years, or is it something that you need the money now because you want to go into something else? So there's a couple of big questions to ask yourself, but I'd agree with the panel. I think it's something that's long-term. Hang on to it if you can. You should potentially see some growth. Alternatively, if that's not the plan and it's not the wish list, then you need to make some commercial decisions with it.
And some great thoughts there, Rob, and from the panel. And I think 2 years is actually a fairly short period of time in real estate or owning properties. And a lot of properties, I've got properties in sort of semi-regional or not quite in city areas that go slow, but then they have a bit of growth. They generally have returned a little bit better for me, and Frankston's probably like that. And a couple of years of slow growth, we have longer than that in capital cities as well sometimes. So I don't think it's a problem to just have a short period of slow growth. Now, our next viewer emailed and asked about buying renovated properties, and says, I'm looking to purchase an investment property, and I'm finding older properties that were sold a few months ago as renovate or detonate are back on the market, fully renovated both inside and out. I would like your thoughts on purchasing one of these renovated properties. So the purchasing of renovated properties, yeah. We've seen the renovate, detonate. There's many more renovation shows, and renovation looks a lot easier than it has been. Yeah. I've done a lot of renovations. They're not always easy. Yeah. Your thoughts, Rob?
Well, firstly, I'd say be very careful with this. You know, there's too many people that have entered into the market quick rich schemes, i.e. let's get in, let's buy the property that needs all the renovation. We can get in and do a quick fix and we can put it back on the market. And the Americans call it flipping, and it's certainly a term that's now come into the Sydney market and as well as Melbourne and through other major capitals, that people are buying these properties with the sole intention to get them renovated as quickly as they possibly can, get them back on the market and flip them for a profit. So first word there is be careful and continue to be careful. It's something that it's fraught with its danger. Should you buy that? you really need to do your research with it, and certainly have the right professionals like a building inspection report if you are looking to proceed with it. But yeah, look, one big word is that is be careful.
And Peter, I've got a copy of your book here, Peter O'Malley, Real Estate Uncovered. So this is kind of real estate, renovate, detonate, then reselling the property. Some of your thoughts, Peter?
Well, interestingly, there is a chapter in the book, Brad, so thanks for mentioning it now. There is a chapter in the book that talks about expensive fittings, cheap build. And in these flick renovations that are quite common in the marketplace, that's what I quite often see as a real estate agent, where the developer or the person running the renovation, it's even a bit crass to call them a developer, cuts corners everywhere but puts in an expensive benchtop and oven, and naive home buyers come in and get caught up in the expensive finishing. So I think what I would say to our emailer there is you must scrutinise the standard of the renovation. Being newly renovated doesn't mean well renovated. So that's a big one. The other thing is I'm actually not a basher of developers. I respect good developers that are out there plying their trade. And unfortunately, development, and this is part of the housing affordability crisis in this country, is development is really, really difficult to profit from. And as a buyer, you need to look at what any renovated property is worth, what its value in the current market is, and if the developer has unfortunately overcapitalised, which many of them do, that's the developer's problem, not yours. You can't compensate a developer that's overcooked the project. So just have a look at value and standard of finish.
And I think on that, very good thoughts from the panel there. Being careful of what standard of everything else has gone into the construction, I suppose, of that renovation, as opposed to just the finishes. It might have a nice bench top, but really good building reports to find out. I've done a lot of renovations, and as soon as you go in, you start finding more things. You find rotted timbers in old houses. You find things that need fixing. Now, as a property investor, retain that property. I go fix it properly, as you should do. I don't cover it up because that'll be my problem in the future. Someone who's just trying to make a quick dollar out of that, which is, I think, very difficult as a renovator these days, because by the time you stamp duty in, your profits get taxed pretty heavily, the costs of selling and things like that. It's a difficult thing, like the developer, to make money from. So anything that comes up that makes it cost more means it doesn't make any money if you do fix it properly. So very careful of those ones, unless someone's renovating their own house that they're thinking of keeping. Often things on the surface may not be what's underneath. We have another caller, Major on the line from Sydney.
How you going, guys? I'm wondering about granny flats. I'm a tradesman and recently did some work on a granny flat and just got talking to the guy, and it seems that the outlay for the cost of putting one up, the return that you get looks fantastic. Do you know, he's basically saying you can put one up on nearly any property. And I'm wondering, do you have the same sort of depreciation on a granny flat on your place as you would on a new construction?
Well, look, Major, I'll answer the depreciation part of that, but maybe I'll go to the panel first.
Yeah, just one thing that concerned me, Major, when you said you can put it up on any property. You can't put it up on any property, and like any of these properties, you need to get proper approvals to put a granny flat up. Yes, they can sometimes do them under delegated authority these days within councils, and that's maybe what someone may have been alluding to when they gave you the advice. But firstly, you can't put them up on any property. Obviously, the depreciation, Brad, you're our expert here tonight on that side of it, and you'll be able to help Major with it. But yeah, that was my first concern. Make sure you check it out before you go and engage the builder to start building the granny flat on the back of the block and finding that you don't have an approval. That's going to be, it'll end in disaster.
And Peter, any experience with granny flats?
Oh, very little. I think there'll be two boom industries going forward: tattoo removal and granny flat removal. That's how I feel about it.
So not a lot of love from the panel on the granny flat there. And Major, look, granny flats, we'll talk on depreciation to start with. Depreciation on a granny flat, if it's used for investment, works very similar to a residential property, unit, house, whatever it actually is. you get to claim your percentage of the structure and claim your percentage of the fixtures and fittings. So it works very similarly, relates to construction cost and the value of the fixtures and fittings in the property. They don't cost as much to build generally as a house, so the depreciation's a little bit lower, but it's a function of the cost. Now, on granny flats in general, we've done a lot of work on granny flats over the last few years, especially, and as the price of property, and especially in Sydney and Western Sydney, increases, the cost of rent increases, and granny flats become inexpensive options for a lack of accommodation, I suppose. As an investor doing granny flats, I've looked at granny flats on a number of my properties. Agree with, no, you can't just do it on anything. You've got to make sure it does fit the criteria. And thinking about the capital value of the property and the future sale value of that property is something that you've got to really be careful of, I think, because the potential buyer of your property at some point in the future, when you do want to sell it, may want a yard back. They may have a family, and we're not talking about the inner city here. We're putting no yard into the where there was a house with a yard and the kids can play. So you're really damaging your potential purchases there a little bit, which will potentially damage your value. The other thing is things are, you spend, you know, $100,000, $150,000 on a granny flat, and yes, you get fantastic returns, which is great for cash flow. Got to make sure the capital value is there. If you spend $150,000 on your property and it's only worth $120,000 more, it becomes a bad equity decision. So that's something to be wary of. I have seen definitely some situations where they go on corner blocks and they work quite well because it seems like two separate properties. Still not as easy to sell as two separate properties, but good cash flow on the way through, and you can get some return on that, and can be seen as two separate properties for the future, because we still sometimes need granny flats for our grannies, which is what they're originally, I suppose, designed for. So, Major, I hope that helps you out. I think we'll have another email now, and Tara has another depreciation question by email about houses and apartments. So it's probably my go again here, guys. But my property question is, can you get a depreciation schedule on investment property that is an apartment and not a freestanding house? Well, that's a very simple question. Apartments and freestanding houses both have depreciation. An apartment has a bit of difference in that it also has common areas. So you own part of that underground car park, if there is one, the lift, the stairs, or whatever it is that's common areas you get to claim for. So at an apartment, sometimes when you look at the depreciation related to purchase price, you sometimes get a little bit more money than you would out of that house at the same price. But with a house, you actually buy some land as well. So the depreciation on a house or an apartment at the same purchase price, the apartment will usually just have a little bit more because you're buying more construction, more structure, and you've also got some common areas. But simple question is, yes, the rules are basically the same, and there's still some depreciation that is available. A bit like granny flats, once again, just a lesser expensive option to build, a little bit less depreciation. You've tuned into Your Money, Your Call, and we're going to take a short break again. But when we return, you'll have another chance to get a hold of a copy of How to Achieve Property Success by calling now on 1300 30 34 35 or email us on property@skynews.com.au. The best question this week will win the book. We'll be right back. Thanks for joining me tonight. I'm Brad Beer, and with me tonight are regular guests, real estate author Peter O'Malley and property expert Robert Klaric. If you have a question for us, you can call us now on 1300 30 34 35 or email us on property@skynews.com.au. Adam has a question about building, selling and capital gains tax. I have some questions in relation to my properties. I have my own home we're renovating worth about $800,000 and a loan of $400,000. We're thinking of selling it once we finish the renovation, cashing in and buying another older place to renovate. Your thoughts? Objective is to reduce the mortgage. Is to reduce the mortgage. 2, we have an investment property with plans and permits to build a unit in the backyard. We're thinking of either selling the back block or building a unit only. Or building a unit. Our only concern is the capital gains tax. Can you help with advice? So let's break this question up, guys. The first question about selling the property and buying another property to renovate, to sell is probably number one. Rob, if you want to...
Yeah, I mean, there's two parts to this question. Obviously, Brad, again, you'll be able to answer the depreciation and as well as all the accounting side of it. But the main part of this question is where I can see is that the objective was to reduce the mortgage. And therefore, if they've got an opportunity now to sell, and I've often said this, and my clients will hear me say this many a times, that you can't go broke making a profit. So I think it's important that if that was the objective, that you finish that. I think that's fantastic. Sell, take the profit, reduce the mortgage. Then the second part of that question was you're looking at maybe investing into that backyard. Now, that is a tough question. I think you need to get a little bit more advice from maybe 3 of the key local agents within the area as to will that benefit the investment or will it actually devalue the investment by having something produced in the backyard? Because that's, again, really the marketplace may see it very, very differently. And as I said, I think it's those 2 areas are really important, but don't be frightened to take the profit and potentially go again. But again, research, don't leverage yourself up too high. Peter?
Look, we quite often get called into people's homes who are considering a renovation and want to know what it will do for end value. And unless that person is in the trades or has someone very close to them that can renovate the property below retail cost, most often the cost of the renovation simply goes on top of the unrenovated property's value. So in this equation, the property might be worth $800,000 pre-renovation. You spend $400,000 on it and it's worth 1.2 or thereabouts at the other end, meaning that you've gone to a whole lot of stress, effort and risk for no benefit. So if you're spending $400,000 in renovating the property, but you're actually getting $600,000 worth of works done because you're a builder yourself, I'd say, yeah, go ahead with it because you're going to create value. But if you're picking up the telephone to have your house renovated with the intention of selling it at the other end, I would say just let it go as an unrenovated property. So it depends on who the profile of the vendor is there.
And look, I think that's a very good point. The concept of a property that's unrenovated is often one that may be attractive to someone who wants to buy it with some skills and be able to renovate it themselves. I've looked at properties where we're putting, and I've been through this, putting properties into the backyard, built, and also have sites that I will build as an investor holding. Very different issue once again, but ones I've looked at in the past, sometimes when there's an old property on the front and I want to do that, I'd consider if there's too much of a renovation on the front house and it's not one I necessarily want to keep, actually selling that front house unrenovated once I've actually built the rear house, because sometimes that can work better. I think development is very different to property investment. So the question of do you have enough knowledge to be a developer is a question you've really got to ask yourself. A developer needs a bit more money, I suppose, really, a bit more equity to actually use and a bit more free cash flow for going through that project, basically. As far as selling after renovating your original property, I think that was your principal place of residence from what I see there. And the concept of being able to sell that with no capital gains tax and be able to move into another one and therefore reduce the mortgage is something that's definitely worth considering. You've really got to look at a lot of those numbers together and see what a lot of those numbers together and see which one actually works the best for you and your situation. Another viewer email. This one's about finance. Does the bank view your property having more value if you're able to subdivide or strata if it's a large parcel of land and you're able to do so rather than being on one title? Peter, I suppose we'll go to you with this one first. Any experience there?
Well, I'd say the bank will go for security. The bank aren't really interested in potential because you, as the owner of the property, are getting the upside of that potential. Quite bluntly, the bank want to protect their position should you go belly up.
I fully agree with Peter on that one. I mean, the reality is the banks don't value on potential or what future is unless you've got the approvals, unless you've actually can demonstrate into the market that into your banks to say, look, I've just got the approvals, I've now got the approvals to either subdivide it, or I can split it into two and build a duplex side by side. That's the only way that you'll be able to present to the bank that there's potentially there's some upside and the value has increased. But the banks will look at purely the security, and they won't look at the potential. They'll look at what is current. So.
And I think a valuer is probably going to often look at a site as a site as it is. To be sold to a developer as a potential development site may be something they'll look at favourably, but it's not yet a development site, and the bank doesn't have the security over a potential development site in the future. Banks generally want to loan you money on what they can get it back from most of the time.
You'd have a whole new market if they were lending on potential of the value. You know.
And the percentage the bank want up front would be far greater than if it were just a standard residential.
I've had experience in myself actually buying property from what was a developer, and it's probably through the GFC. They've bought, they've paid a certain amount of money. I ended up buying them as houses, not as a developer. The fact is they're still like a development site. I've gone and done valuations as houses and financed them as normal houses. To me, it's a development site. And once again, the risk with developing is that you actually need to you need to develop to keep moving. I am a property investor that is going to develop on that land, therefore not required to develop to make money. I make money out of my normal job, and I'm a property investor with the ability to actually be able to develop that into a property later on, and that will work quite well when we eventually get that one built. Now we're almost out of time, and I hope you've enjoyed your show this week. Keep watching all throughout January, and then in February, Margaret will be back to kick off 2015 with a great guest lineup. Thanks to all the callers this week. This week, our question of the week will go to the renovate or detonate. We think that's a great question that a lot of people with renovation shows on television at the moment are seeing that. It's difficult to make money from, and I think that's probably really one that's worth giving the book away. So if you could email us on yourmoneyyourcall@destiny.com.au, Margaret will send you a copy of your book. Thank you to our guest tonight, real estate author Peter O'Malley, and I've got a copy of the book there, so I'll have to read that one, and also to Robert Klaric. Before we go, one more reminder to go to yourpropertyteam.com.au to get your tickets now for our one-day property intensive in Sydney on the 28th of February 2015. Tickets are very limited, and it's a once-a-year event. So don't miss out. Thanks for being with us tonight. I'm Brad Beer. Have a great new year. Until next year, good night.